Bloomberg.com.
Let's wrap up a busy trading week. 20 seconds to go until the opening bow this morning. Good morning. 2 days of really powerful gains on the Nasdaq and on the S&P for that matter. Can we make it 3? Futures up 0.4% on the S&P, on the Nasdaq 100 higher by 5 or 0.6%. The Russell just squeezing out a small gain, up by not even 0.1%. As your opening bow, switch on the board and get to the bond market. Line of the morning goes to Michael Harnett of B of A. Dove at first sight was the title of his Flow Show report this morning. Yields higher by 2 basis points on a 10-year, 269.93. It's the story of the week, isn't it? Weak economic data, yields lower at the front end because people believe the Fed's going to back away, and then a whole host of guests on this program say, no, not too fast. Euro dollar, 101.58, negative 0.4%. CPI hot, GDP okay for the Eurozone, not for Germany. They're looking at a stagnating economy and really hot inflation. And how many times have we said this about the ECB? Somewhere between a rock and a very hard place. Crude 99.79 higher by 3.5%. That's the cross-asset price action. Let's get you some movers. Here's Abby.
John, lots of earnings movers to get through. Some leaders and laggards, starting out with what's working, not surprisingly, big tech. We have both Amazon and Apple up sharply. This after both companies put up interesting quarters where quarterly profits, the growth declined, but you had some positive spots for Amazon. That was sales beating by 1.4%. Better than feared, really, is one way to describe it. Guidance was strong. For Apple, of course, Tim Cook, the CEO, very strong on the end of the year in terms of iPhone sales, could really be even more improved. Also optimistic about supply chain constraints in China perhaps improving. Intel, though, not so much. A disaster, down 11%. Huge misses, a surprise loss. The biggest revenue drop in more than a decade. They cut guidance. Investors clearly not liking it. And Roku, down 24%, the worst drop ever going back to 2017. A mixed quarter, just a bad quarter, wider loss than expected as ad spending slows. However, the energy complex, very strong. ExxonMobil, Chevron, Phillips 66, all put up very strong quarters, buybacks in place. Procter & Gamble, though, John, of course, you've been having this debate on the consumer and the recession, whether or not it's a recession. Well, Procter & Gamble, as you know, that stock down 4.7%. Management is talking about slowing growth as consumers pare back. Those are on staples products, so that could be some sort of a warning looking ahead.
Abby, thank you. Some big movers out there, including Amazon. This is a third straight day of gains. Over the last 3 days, that stock is up by about 17%. That is about $200 billion of market cap in that one name alone over just 3 days. And the third day is not over yet. Earlier this morning, Exxon, Chevron posting record profits. Those numbers look good. So does the stocks. Let's get to Kelly Lyons for more. Hey, Kelly.
Hey, John. Well, it's no surprise that these companies are raking it in, but even the sell side didn't expect them to rake in so much. Exxon beating its previous quarterly record by $3 billion in net income. For Chevron, their previous net income record back in 2008 was about 50% less than what they pulled in the quarter just reported. Their EPS topping estimates by about 18%, and Chevron, of course, also boosting the top end of its buyback program to $15 billion. When you put those two together with the other oil majors, we're talking of $64 billion in profits this quarter. They are just absolutely printing money, and of course, that's because their business has become a lot more profitable. It's not just higher oil prices, but also refining margins that, yes, have come in over the last 2 months, but still they are really elevated relative to history, north of 40%. And obviously all of that has translated into market performance. John, Exxon up a whopping 50% this year already, even before the gains of today. Chevron by about 30%. That absolutely dwarfs the broader market, which is in negative territory still on a year-to-date basis. So these companies are doing really well, John, and it raises a political question as the Biden administration has continually pointed at the oil sector, accusing them of prioritizing shareholders over consumers. Both Exxon and Chevron in their statements today trying to push back on that narrative, saying we're investing more, we're refining more, we're trying to help you meet demand. I wonder if we'll get any reaction from the White House over the course of the trading day, John.
I guess the good news for them is that gas prices have been going in the same direction. Kaylee, awesome, as always. Thanks for being with us. Apple rolling over a little bit, positive about 1.9%. Amazon off the highs, positive by about 9 percentage points. That's a move, isn't it? John Hancock's Emily Rowland back with us. This is what she's got to say. Earnings revisions are now rolling over as analysts are incorporating lower guidance. Seeing equity markets reprice higher as estimates get slashed is an indication that investors may be overly optimistic. Emily, I'm pleased to say, is back with us for a final word. Emily, you mentioned your review of earnings. For those that missed it, let's go through it again.
Yeah, no, so again, the results are coming in a little better than expected, but they're still not great. And importantly, we look towards the future, and we do believe that there are going to be challenges continuing for companies as, labor costs remain elevated, as supply chain issues persist, the dollar continues to strengthen here. So we want to be really cautious, and we want to notch up on quality. This is not the time to own companies that need to tap the capital markets in order to see durable profitability. We would fade that part of the market. But we would look to embrace areas that have great balance sheets, great return on equity, a lot of free cash flow, and that's really where that rotation should take place. We'd even add an element of defense to portfolios. Tying it in here with the economic cycle, I know I love the last word, but I know it takes just a little bit more time to get my point across here. We do think that economic data is probably going to get worse from here. And right now investors are pricing in this idea that maybe we should be looking at buying the dip. We don't think that we're there yet. Friends don't let friends use backward-looking economic data to make decisions.
Well, there's no dip right now either, given the move we've had since June. Either we're up by more than 10% off the lows on the NASDAQ 100. Yeah. Emily, resilience, quality. Within tech, can you help me understand where that is? Where defensiveness is? Because within tech this week, we've had Facebook bad, Alphabet a sigh of relief. Right? And then you've got the retail trades, you've got Walmart bad, and then you've got Amazon a sigh of relief. What is it? Where should I be?
Yeah, that's pretty notable to us, and we've been actually underweight communication services and overweight technology because in the tech sector, particularly in areas like software, hardware, you're going to find companies that, again, have that higher, more durable profitability, that strong free cash flow, lots of cash on their balance sheets, earning stability. I've been a little bit surprised by Amazon. Quarter after quarter, they show that they're not making money. Those aren't actually the types of companies we want to own in this environment. But again, those good, solid earnings growers within tech, your sort of classic technology companies, that's where we want to be right now.
Emily, you had the final word, at least after Tony. Emily Rowland, thank you. It's good to catch up. As always, let's catch up soon. Amazon up by more than 9%. Apple up by 1.6%. Better than expected results across the board for Apple and Amazon, putting the S&P on course for a third consecutive day on gains. On the West Coast, he's been up all night looking at this. Let's get to Ed Ludlow for more. Hey, Ed.
Good morning, John. The sell-side reaction to Apple is that the iPhone sales are holding strong, unencumbered by the changing global economy. The sell-side reaction to Amazon is that it is greater than the sum of its parts, that despite what we see in some online sales softness, it's helped out, of course, by AWS and by some surprise strength in advertising. But really the story here is that this is the new era under Andy Jassy. Real emphasis on cutting down operational expenses, real emphasis on investing in AWS rather than the prime side of the business. The prime side of the business, of course, was a real Bezos era priority, especially during the pandemic where they were trying to look to fulfillment. Apple, a mixed bag. Yes, a beat on the top line, but ultimately that was supported by iPhone and iPad. Weakness and a miss when it comes to Mac and wearables, and China's a big part of this story. Overall, sales in China beat. And for a company that does not give guidance, in an interview with Bloomberg TV's Emily Chang, Tim Cook gave us a pretty good guide. In the fiscal third quarter, macroeconomic headwinds impacted the company, but things improved, particularly in China, both on the supply and the demand side in the month of June. And as they move towards that June 18th sales period, holiday period in China, there is evidence that they are strong there. They expect revenue growth to reaccelerate in the fiscal fourth quarter ending in September, and a slowdown in services, which is worth noting because the street was hoping that that would be a bright spot. But as you say, a sigh of relief, my shoulders have relaxed, a busy week.
You're done. Get some rest. Ed, it's good to catch up. Great work this week, buddy, as always. Only one man could write a quote like this. Apple's results, a Top Gun Maverick moment. Here's the quote. The street was waiting for any signs of demand issues from Apple and instead got the opposite. With China headwinds and supply chain as a peak issue in the rearview mirror, for now, Cook & Co. laser focus their sights on the iPhone 14. Of course, that is Dan Ives of Wedbush, and Dan joins us now. Dan, where did that iPhone beat come from?
Look, I think China was the shocker, down only 1% given the shutdowns. I mean, that was really surprising to the street. And I think it just shows the demand story holding up really globally. And that's something that's a Rock of Gibraltar stock. And even in these economic storm that we see, Cook, when he talks, everyone listens. And ultimately, if you look going into September and I think year end, Bark's a lot worse than the bite in terms of demand fall off, and I think that's why the stock, in my opinion, goes higher from here.
Dan, you've been a bull for a long time. I'm looking at the numbers from AT&T on T-Mobile, delayed bills, and I've been asking myself, if people are in a tight spot right now, where is your bill for the Apple iPhone, that monthly payment, where does that come on the hierarchy of things?
Look, I think even when you look at the install base, 225 million have not upgraded their phone in 3.5 years. Even if you take 5–10% off that, given some dark macro headwinds, that would be better than the street. So I think it's all relative to what was baked in here. And also services, there are a lot of worries on that, and that was much better than feared in terms of whisper numbers. I think you start to put the story into the next year. I think Street's baking in a lot of bad news, and everything we've seen from Asia, iPhone 14, in terms of out of the gate, is going to be pretty much in line with iPhone 13 from units.
Dan, you've covered this name a long time. How has it stood up against a real cyclical test? And 08-09 doesn't count because the iPhone had just come out. And I don't think the pandemic counts either, because we had massive fiscal transfers that supported the consumer. Dan, what have you learned over the years about how this name and iPhone sales stand up to cyclical pressure?
Look, it's been almost Tom Brady-like in terms of how it stood up. And I think that's the one thing I'd point to, is that we can talk about recession and cyclical and ultimately what we see across the board. And I just believe when I look at the ultimate demand story, what's happened on services and even some of the new products coming out next year, the chip issues are starting to moderate. And I believe this ultimately will be a stock over the next 6–12 months that starts to back approach $3 trillion.
You hope the peak problems are in the background. $3 trillion is a number you've been talking about for a while. I want to end up by talking about the dispersion within this sector, Dan. It's something you've been talking about too. Within tech, ad revenue versus cloud, that's only one piece of it, because I can look within ad revenue. There are winners and losers over the last week or so. The obvious losers being Snap, Facebook, Meta, another one, the winner Alphabet. Dan, what have you made of execution? I don't think execution is talked about enough. What have you made of the execution within this sector and the dispersion you're expecting in the quarters ahead?
I agree. It's a phenomenal point. I think it's a bifurcation, a parting of the seas in terms of tech. Snap was a Friday the 13th horror show. Google and even Facebook, I think, better than expected. I think what you're starting to see, tacticians like Cook and Nadella, Hall of Fame CEOs, look how they're navigating their business. Certain pockets holding up well, enterprise, cloud, cybersecurity, but others, some of the high multiple froth, no E in terms of earnings, those names could continue to sell off. And that's why I think it's a bifurcation that we're seeing in tech, led by Apple and that company in Redmond in terms of moving us higher.
Dan Ives, awesome, as always, of Wedbush. You're keeping the faith, I know you are. Others are still questioning the Apple story, and for many good reasons too. Dan, wonderful to catch up, sir. Coming up, stocks heading for their biggest monthly advance since November 2020.
The market has seen earnings that are not as bad as feared, and perceived Fed to be dovish. I wouldn't necessarily be chasing it at this point.
We'll break down the month that was and the road ahead. We'll do that with Nuveen's Brian Nick up next.
market have seen earnings that are not as bad as feared and perceived Fed to be dovish. I don't think Fed is pivoting here. I don't think the market is pivoting. We're going to see some of these gains taken out in the market. So I wouldn't necessarily be chasing it at this point.
More gains right now, up 0.6% on the S&P, on the Nasdaq up 1%. Good morning to you. Some breaking news. Let's get that data. Here's Mike McKee.
John, the Chicago PMI comes in down for a second month in a row, but it's still positive at 52.1. That's down from 56. A lot of people have been paying attention to the regional indicators of economic growth. This is a tease ahead to Monday when we get the ISM number, but the Chicago number joins a couple of others, Empire and Philadelphia, in being a little bit higher than they had been. And that breaks a bit of a trend in these indicators. These are all July numbers, so they're a little more timely than some of the others that we've had. We'll see what happens with the national number on Monday.
And you'll break down you, Mitch, at the top of the hour in 13 minutes.
Absolutely.
Mike McKee, looking forward to it. Thank you, sir. What a month over the last month for stocks and for bonds. Equities now heading for their biggest monthly advance since November 2020. Breaking it down, here's Taylor Riggs.
Yeah, John, and you really see on the terminal chart, again, that big monthly increase finally after 3 straight months of losses. So a little bit of a rebound. Change up the board as well, and you can see that it is all led by big tech. Apple, Amazon, of course, the big winners this morning. That has really been the trend of the last month, as well as big tech firmly back on top. Interesting, though, it has been a global story. Certainly not China tech participating in this, but MSCI ex-US, big rebound as well. You're finally back up about 3%, John.
Taylor, thank you. Wonderful. Looking forward to the close a little bit later with Taylor Riggs and the team. Joining us now, Brian Nick of Nuveen. Brian, first question. It's $1 trillion question. What's the difference between a bear market rally and something more durable?
Well, I think we're going to need to see more reassurance that interest rates aren't going to come back to bite us. And I think if you look at what the Fed had in mind for 150 basis points of rate hikes in about 8 weeks, probably wasn't easier financial conditions, a higher equity market, and a lower 10-year. But that's exactly what we've gotten. Meanwhile, we're still getting hotter than expected inflation data. So this doesn't feel like a stable equilibrium to me. So I guess I would say more in the kind of bear market rally, less in the durable rally camp at this point.
Brian, you've got to ask the inflation question. Any reason to believe the inflation surprises subside anytime soon, and sufficiently so for this Fed to back away?
Well, this is why we have this strange situation where the market seems to be at least occasionally cheering worse than expected data on the growth side, because it's only a weaker economy and demand destruction it's going to get us to softer, durably softer core inflation. That 0.6% core PCE rating for June, that was an eye-opener, and the people at the Fed are going to be paying attention to that as well. This isn't just the oil prices from Ukraine, Russia anymore. This is other things rising in price, and things that are harder to bring down again, like rents and like other services costs. So I think for the moment we're in this higher inflation world, and it's only when we start to see perhaps less security on the job front, people behaving less confidently, maybe saving a bit more every month, that we're going to start to see this inflation narrative come back down.
How quickly before you think this dual mandate of this Fed is in conflict? Brian, I'm hearing from Bank of America this morning. They're expecting the labor market to slow quickly and soon. Do you share that view, and do you expect to see those kind of data points by the time this Fed meets at the end of September?
Well, the labor market is starting from such a strong place that even a sort of a sequential weakening, if we got, say, 150, 200, 250,000 payrolls next week, that's not going to be the end of the world. But I think the Fed's made pretty clear that they expect the unemployment rate to be going up. Now, some of that is just demographics, and we have more people moving to being out of the labor force, so that may happen, somewhat naturally. But I think as we, start to see, again, questions about company profits, large segments of the economy talking about weaker demand in the second half of the year. Why are earnings estimates turned over for 23? It's because I think a lot of firms see weakness ahead. If they start doing layoffs, that 400,000 job per month average that we've been accustomed to is going to get weaker pretty quickly. I still don't think we're in store for a sharply higher unemployment rate situation, getting to say 5.5%, 6%, which I would put in the sort of severe recession category. I think the job demand is so strong right now by employers that even a sequential weakening from here is going to let us get out of this okay on the other side, what I would say a modest increase in unemployment.
Isn't that what we're pricing, Brian? Isn't that what we're pricing now, what you just described at the end?
I think so. I think that is what's priced in, but I feel like that's also what I'm describing as sort of the best case scenario. I don't think we're going to get out of this without any change in the unemployment rate. So if you think you're priced to perfection and you're continuing to see the unemployment data, the ECI number this morning was really bad. 1.6% for private sector wages and salaries. That's much higher than the Fed can tolerate. And so I think they have to stick to it. I'm really surprised we haven't seen a repricing of the September FOMC from 50 to 75. I suppose there's a lot of data between now and then. But if the Fed's going at 75 basis points for the rest of the year, that puts that severe recession scenario back on the table, and it means that where the markets are pricing right now is just not right.
I think the reaction function is clear as mud. And Brian, that's part of the problem, isn't it? We all know what data to look at. We just don't know why it matters so much anymore, because they flip from one thing to another. ECR to you, Mitch, headline to core. And we're going to have to wait for the Fed speakers to tell us. The Atlanta Fed president this morning, I think, told us, I don't know if we were listening, basically said the economy is resilient and we've got more work to do. Amazon's up 12%, Brian. Apple's up by 3.5%. It's a pretty powerful move over the last 3 days. Tell me how you'd use this strength to reposition. That's a question I asked Tony Dwyer. Let me finish up with you and ask the same one.
Sure. So I would say, without getting completely defensive and moving into the really low growth areas, I think we're moving up in quality across every asset class. If you ask us what our highest convictions are across the board, we'd actually say at this point is probably municipal bonds, corporate bonds. So we have an overweight to bonds versus stocks right now. That was before this move. So I think our conviction is probably increased maybe just a bit further. That means we are positioned for a macro deterioration. Being long duration, for example, is going to help you, we think, if the things turn over quickly. But all of these trades are still exposed to the further lurch higher in rates and a repeat of what we saw in the first 6 months of the year. We know from experience there just aren't that many hedges for that scenario, which is why what we are seeing, the moves we're seeing in these higher growth companies at this point, is nice to see from an earnings perspective, but also somewhat concerning from a valuation perspective.
Brian, Nick, the easing of financial conditions and whether this Fed's going to push back in the coming weeks is going to be interesting. Brian, Nick there at Nuveen. Good to catch up, buddy, as always. Up next, your trading diary as this market moves into a third straight day of gains. This is Bloomberg. We are looking at 3 days of gains. Will it stick? About 26 minutes in, stocks higher by 0.7% on the S&P. That's the price action. Here's the trading diary. Top of the hour. University of Michigan Consumer Sentiment Survey. Then next week, ISM manufacturing numbers Monday. Fed speak returns with Evans and Bullard on Tuesday. A Bank of England rate decision coming up on Thursday. And finally, Really, already? It's the payrolls report next Friday. I have no idea. From New York City, thank you for choosing Bloomberg TV. I'll see you a little bit later for Bloomberg Real Yield. If we miss each other, have a wonderful weekend. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Friday, July 29th. Here are the top market stories that we're following for you at this hour. We're still spending for now. Numbers hold up while paychecks rise and inflation hits another 40-year high. The market preps, though, for more Fed tightening. We're going to speak to Jan Hatzius, Goldman Sachs chief economist. And big oil rolls in a pile of cash. Exxon and Chevron deliver record profits, and Chevron announces a huge buyback and considers raising its CapEx budget. How long the good times can roll for the majors. Meanwhile, poor Intel. Inventory backlog chips away at Intel's earnings. Stock gets pummeled in the market. We're going to speak to the CEO, Pat Gelsinger. From New York, I'm Alex Steele, my co-host in London. Anna Edwards, Guy Johnson is off today. Welcome, everyone, to Bloomberg Markets. I feel like we have a push and pull of the idiosyncrasies that we're seeing in terms of earnings, and then the still big question of when the Fed can continue and how far they're going to have to go above neutral lines. Like, that's like the push and pull a little bit in the market now. Absolutely. It's sort of macro versus micro. And whenever the macro makes us think twice about whether we're getting close to that pivot point for the Fed, Alex, it's as if the earnings stories are just in there just to support us. Certainly that seems to be the theme of the last few days.
Yeah, let's get to some of that macro here. So we just had Chicago PMIs coming in lighter than estimated 52. We're also getting the final read on UMich. Remember, the long-term inflation expectations in UMich was one of the reasons that Powell cited the first time for going 75 basis points. Those rose again to 2.9%, so a little bit more than the second reading. We're also looking at one-year inflation expectations, though, holding steady at 5.2%, and the current conditions also a little bit better. I want to get more on those numbers with Michael McKee, Bloomberg National Economics and Policy correspondent. Mike, I'm just curious, well, what's your read on this one? I mean, is it better? Is it worse? What's your big takeaway?
Well, I think it's a little bit better, Alex. The move from 2.8 to 2.9 on the longer-term inflation expectations is probably just statistical noise. We've seen it come down significantly over the last couple of weeks. The June number was 3.1%. So Americans are watching the gas pumps and they're seeing prices come down, and that's being reflected here. The Michigan sentiment number overall goes up 51.5 from 51.1. People feeling a little bit better about the economy, and their current conditions number goes up to 58.1 from 57.1. So this is probably a reflection of the fact that gasoline prices are starting to come down. Not a lot of other inflation numbers are coming down, but that's the one that's most noticeable. Now, expectations for the future, interestingly, doesn't change. 47.3. It was 47.3 in June and 47.3 in the preliminary. That's the lowest since 2009. So people don't feel good yet about what's going to happen 6 months to a year down the road, but they are feeling a little bit better about today because it costs them less to put the money in the gas, the money in the tank.
What's the broader picture on consumer sentiment then, Mike? If this is the Michigan sentiment number, and as you say, it ticks up slightly, what does the broader picture look like given the size of the services economy and the consumer economy in the United States?
Well, we had the Conference Board survey show basically sort of the same thing earlier in the week, with a decline in the headlines and expectations numbers and a decline in buying plans. And that really came through today in the personal consumption numbers. When you subtract inflation out of it, they were only up 1/10 for the month of July. So Americans not feeling great and not spending a lot of money at this point after inflation. So there may be a bit of more of a correlation, contemporaneous correlation than sometimes we see between confidence and spending.
Murky stuff. Mike, thanks a lot. Really appreciate it. Bloomberg's Michael McKee joining us there. That's the macro picture. And then we still have the micro, which is earnings. And starting to hear some of the same things about the consumer, which turns us to the question of the day. I think earnings are, you fill in the blank. It is your call. Joining us now to discuss just that is Anastasia Amoroso, iCapital Chief Investment Strategist. So if I were to ask that question, I think earnings are?
I think they're better than feared.
Okay.
I mean, everybody was expecting a pretty terrible earnings season, and specifically we're expecting that guidance is going to be revised significantly down, and that's not been the case. So, Alex, if you look at the surprise number that we're getting, of course, it's much less than we were getting in the last 4 quarters, but it's actually in line with historical average. If you look at the number of beats, they're, again, a little bit worse, but they're, again, in line with historical average. But I think the big consolation for the market is the fact that we're starting to see the numbers for 2023 come down, for example, but it's not plummeting by 5 or 6%. It's falling by 1 or 2%, maybe at most. And I think that's what's giving the market a lot of consolation here.
Anastasia, good to speak to you. Good afternoon from London. Another way to answer the question, I think our earnings are distorted by energy. Is that something that concerns you?
I mean, obviously, energy is a big outlier here, and it's one of our favorite sectors as well. But no, it doesn't concern me greatly, because if you look at the sectors, they are surprising in general, and there's lackluster growth for sure, but there's still growth, and I think that's what's really most important here. We have not heard terrible guidance. I mean, sure, there's some retailers that have been impacted more so than others, but even if you look at the tech trade, for example, and if you kind of, detangle the FANG trade, there's still companies that are tied to cloud, they're tied to enterprise spending, they're growing quite nicely. They're slowing down, but maybe cloud is not growing at 40%, but maybe it's growing at 33%, and that's a very good thing. So I don't think it's just the energy trade that's really keeping the earnings intact here.
So to that point, it felt like my takeaway from this week also was that if you're exposed to certain parts of the consumer, you're feeling the pain because consumers are spending, but what they're spending on is changing very quickly, and that's really creating some winners and losers. Do you think that we've re-rated enough on the loser side at this point?
On the consumer side, Alex, I'm not convinced because I think the consumer is going to continue to feel the pinch. And you're exactly right. If you look at retail sales, or if you look at the GDP report that we just got, the consumer is spending on essentials. It's about gasoline, it's about food, and that's really what's crowding out the rest of the spending. And unfortunately, inflation is not going down to 2% anytime soon. It's not going down there quickly. It seems like next week we might see a little bit of softness in wage increases. They were growing at 5% plus. Next week, I think we're supposed to get a 4.9% number on wages. So I still think we're in the environment where the consumer is going to continue to be squeezed, and it's about spending on essentials. So yes, it might be tempting to kind of pick up the pieces in retail, but not tempting enough for me. The way I would think about playing the consumer is perhaps through the financial sector, because I think overall defaults should stay kind of in line with recent history. So that's how I would think about that.
That's interesting. I was wondering whether the earnings story was telling us a tale of two consumers, Anastasia. One that is squeezed, as you described, and one that seems to have the money to go and buy luxury goods. And I mean, maybe that's more of a global story, a bit more of a European story perhaps, but all of the luxury companies reporting this week, Hermes, LVMH, Kering and the rest, telling a very resilient story. That's more than the US, obviously. That's a global picture. But I wonder if that's an investable theme around luxury.
I think it is a tale of two consumers for sure. Of course, the lowest quintile of consumption spending is squeezed very much, and 94% of the consumption happens to be on the essentials like food, gasoline, transportation, and shelter, and that's not the case for sort of the upper income class consumer. But I don't think that part of the consumption basket is immune either. Part of it has to do with future wage increases. I think part of it has to do with exposure to financial assets. And I think where the upper class consumers may get squeezed is that this has not been a great market for returns of anything. So I probably wouldn't count on the luxury to be the leader here. And Anna, at the end of the day too, it's all about margins. I just don't see the margins in the consumer discretionary sector being the best ones out there. I think they are already tight, they're getting squeezed, and so where I would rather take that margin risk would be in a sector like software, for example, where those margins are 2 times that of the S&P 500, and the enterprise spending I expect to be a lot more resilient than retail.
So also, if you want to look at margins, you have to look at energy. I mean, you had Chevron just blowing it out of the water. These guys are minting money, and most of them, except for Exxon, is throwing back so much cash to shareholders. You've been a longer-term bull on the energy trade. So at this point, would you still be buying energy, or do you want to lock in the profits? What do you do?
I think at this point, Alex, you do step back into energy, and I will tell you, back in May, one of the things that I was becoming concerned about is that we were starting to see softening in gasoline demand, for example. We're starting to see softening in distillates demand, but energy prices and energy stocks were up here. Well, guess what? They have corrected since then. They're down about 18% since that 52-week high. So at that point, I would actually like to re-enter the trade, because if we manage to avert a recession, and that is my base case, if we manage to have the soft landing, then demand is going to be there and the supply is still constrained. Oh, and by the way, the Strategic Petroleum Reserve releases run out in October, so we're still going to be in a pretty tight oil market. So I expect oil prices to be around $90 to $100 a barrel, and guess what? That bodes very well for some of these energy companies.
Anastasia, thanks so much for your time. Good to speak to you. Anastasia Amoroso of iCapital joining us here on Bloomberg Markets this Friday. Coming up on the program, we'll stick with the theme around energy. Record profits for big oil. ExxonMobil and Chevron set new marks. We will talk with Sankey Research lead analyst Paul Sankey. That conversation next. This is Bloomberg.
the Fed makes its call.
The committee raises the target range for the federal funds rate.
75 basis point hike.
Bloomberg is there with live coverage.
We're moving expeditiously.
But where are you in the journey?
We're not sure.
And instant expert analysis.
The answer would be easy if the Fed wasn't so late.
If we start to see real softening, we'll have a different conversation at the Federal Reserve.
They're massively constrained by the real economy.
Nobody covers the Fed like Bloomberg, your global business authority.
Exxon and Chevron out with earnings today. Both stocks up in the market. They really crushed it. You had a record profit over at Exxon. Chevron boosting its buyback by 50%. These are enormous numbers as these companies just throw off tremendous free cash flow. So let's get back to our question of the day with an oil lens. I think earnings are blank, blank, blank. You get to fill in the word. With us now, Paul Sankey, the lead analyst at Sankey Research. Paul, it's always a pleasure. That's the question. I think oil earnings are.
Probably at a peak. So I think that is a problem, and it certainly seemed like a problem for Valero yesterday, which just, again, had enormous earnings. The question being that why did the market then sell the stock? And of course, the concern is, are we going into recession, and do you want to own a refiner into a major recession? So it's a tough one. Having said that, this quarter to date already, Alex, as you know, we're doing $110 Brent as of today. Refining margins are still $40 a barrel, so the stocks do look exceptionally undervalued.
Paul, what are the signs that you might think that we are at a peak?
Well, I just don't see at this stage how things could get a whole lot more dramatic than what we saw in Q2. Having said that, we do believe that the refining capacity problem is structural. We think that the global, particularly European gas crisis is structural. And keep in mind that Europe is competing with Asia for that gas, so it is a global gas crisis. So those are two areas where you could say, we're going to sustain extremely high prices on an ongoing basis. The tough one is if we go into significant demand weakness, will we be forced to see lower margins? And that combination of supply crisis with demand strength in Q2 2022 was a pretty big setup, right? So I think the earnings are at a peak, basically.
So before we get to, and we'll get to that in just a second a little bit more, I just wanted to highlight this Chevron's higher buyback. So they've been really adamant that shareholder reward is going to stay, that they're not going to raise a buyback and then cut it when oil prices fall. So the fact that they raised it this much makes me think that they see a pretty bullish environment. And I guess my question to you, Paul, do you feel like that maybe is a Chevron-specific kind of thing at $100 oil, or do you feel like it's more of an industry signal?
Well, no, actually, the Chevron thing is a little bit different because what they want to do is rate the buyback. So not only have they not cut their dividend, I think now it's sustained nearly 30 years of rising dividend through thick and thin, which obviously contrasts very positively with European big oils, Shell, BP, Total. Exxon has maintained its dividend too, but Chevron's got a better growth track record. But what they want to do is when they start these big buybacks, they want to sustain them without cutting the buyback. And that means, the move that they're making today is very significant. It really does speak to the idea that they believe they're going to structurally generate very high profits on an ongoing basis. Absolutely.
Paul, good afternoon from London. So returning money to shareholders at Chevron. Also, they're talking about possibly increasing CapEx, increasing production. How much more could they be doing at Chevron?
Well, I think the Permian is very tight, right? So, I think that there is the potential for some offshore drilling and, maybe some new exploration just because the global oil supply situation just looks so chronically bad. We have a major problem with global oil supply. If you look around the world where there's growth, you really have Guyana, maybe Canada, the Permian, but the list is remarkably short. And then if you look at the performance of OPEC Plus, as you know, it's been massively underperforming where its volumes are meant to be according to quota. And of course, within that, you're including Russia. So there's a global oil supply problem and a huge weight of global population pressure. So I think they're thinking maybe we'll go out and, try and add some additional incremental barrels over time.
Paul, to that point, though, costs are also super high. Chevron actually was able to keep its costs down 25% versus 2019. So the idea that there's not that many places to drill, at some point they're going to have to increase their capex, but costs are still so high. And I'm wondering how many levers do you think these guys have left to pull to make shale more efficient, to offset the labor issues, the supply chain issues?
Well, there maybe it's just some messaging here in terms of, the government is watching, and they want to say, look, we're trying to spend more. Actually, you caught me a bit short here because the Chevron call is going to start at 11 this morning, so we haven't had the conference call from the company. For more color, we've just done the Exxon call. And Valero, by the way, yesterday was saying they're not seeing any demand destruction, which was an interesting comment on their call. No, it's definitely tough out there because you do have this labor shortage issue. You do have a quality rig shortage issue. You do have a steel availability issue. So, it's very hard for these guys to ramp up spending significantly.
Paul, in terms of where we are on the oil price right now, I spoke to Amrita Sen earlier on here in Europe, and she was saying, she was asked whether if there was a real change in the Russia-Ukraine story, whether that would have a really big impact on oil prices. And she said, look, we're just not at these levels because of Russia. Would you go so far as to say that?
Well, again, yes. I mean, Valero said that yesterday on their call, which is that Russian crude oil has not come out of the market, and the Russian heavy fuel oil for upgrading is actually coming back into the market. So what's so staggering about this $110 Brent price is that we really haven't lost that much Russian oil at all. And, in that environment, with also Libya coming back strongly and Iran's smuggling, that's why I'm talking about a global oil supply crisis. I mean, it's incredible to be at 110, with all these barrels still in the market.
It really is, Paul, particularly as we're talking about recession a lot on a macro level. Hey, before I let you go, Paul, I wanted to just ask you about the $370 billion in clean energy spending. Do you think that oil majors don't or do like it? It seems like they got some stuff in this that might make their life a little bit easier. What do you think?
Apparently, it's going to get fought tooth and nail by the progressives because, there is that leasing stuff in the bill for the oil and gas companies to offset, new permits for windmills and solar. It's not as dramatic a deal. Whether or not the bill passes, I think, is the big question for us. I think the real beneficiaries are obviously going to maybe be wind and solar, but I have no idea how they think they're going to reduce U.S. emissions by 2030 by the amount they say, based on what I see in that bill, which, by the way, is brutally difficult to read. I don't know if you've actually read the thing, but it's
no way.
completely incomprehensible, basically.
And we were looking to you, Paul, for the précis. Never mind, next time. Talking of the relationship...
I tell you, it defeated me yesterday.
Talking of the relationship between these big oil companies and governments, in Europe, where I am, here in the UK, and also elsewhere, in Italy and in Spain, we've seen windfall taxes, the word used in the media a lot, applied to these businesses. Is this something that you see catching in other jurisdictions?
Well, obviously the concern would be that the U.S., makes some sort of move towards that. But our understanding is it's more or less been dropped. I think you can kind of argue that it's un-American or something to tax companies just when times are good, and I think people are sympathetic to the fact that nobody helped these guys out during COVID when they were losing money hand over fist. And, I think also the government's realizing that a windfall profit tax won't help the oil and gas supply problem that we have. And that's a pretty good counter-argument by the big oils.
Okay, Paul, thanks very much. Thank you very much. Thanks for joining us. Paul Sankey from Sankey Research. Great to get his perspective on all that is going on in the oil sector right now and energy more broadly. Still ahead, it is Friday, which means on this program, it is ETF Friday. As the month comes to an end, we will look at where the flows went to in July. Here's a clue. We'll be talking about this. We'll also, which is the S&P 500. We'll also talk Treasuries. This is Bloomberg.
Amanda Gordon.
Our time now for ETF Friday. It has been a serious month here. The S&P having its best month since November of 2020. And what are the ETF flows actually telling us? Joining us is Bloomberg's cross-asset reporter and the host of ETF IQ, Katie Greifeld. Katie, are they abandoning everything of safety and just like loving stocks right now? Or are there some other things going on here in terms of flows?
You might think that, but it's actually a little bit unintuitive if you actually drill down into the flows. So it wasn't straight up euphoria. You did see some hints of that. You do have VOOO there. That is an S&P 500 tracking ETF. But, I mean, it was the Treasury funds that were the big winners. If you look at GOVT, you look at TLT, you look at TLH. Those are long-duration Treasury ETFs. So still a hint of caution. I would say the cohesive gel there would be that, if the Fed does hike us into a recession, long-dated bonds and stocks theoretically would do well if the Fed was ultimately forced to cut interest rates. But you did see some hints of risk appetite. LQD, that is an IG investment grade corporate bond ETF. So $3 billion there, it's not too bad. Yeah, 3 out of those top 5 then, Katie, treasuries essentially, aren't they, of some description. Elsewhere then, but I guess that fits with the broader picture because we saw the best month for stocks since the end of 2020. We also saw the best month for bonds since the end of 2020. So no surprise to see them both reflected there, I guess, in these ETFs. What about the dividend plays, dividend themes? Because whilst we're going through earnings season, a lot of people thinking about where they're going to get that income from and where those dividends are safe.
Exactly, and I would lump that into sort of the same sort of vibe that's running through those treasury flows that we just talked about. Basically, capital preservation, a hunt for a steady stream of income. You're definitely seeing that if you look at the dividend ETFs. The Schwab U.S. Equity Dividend ETF in particular, this is striking. It has over $8 billion of inflows year to date. Wow. But if you look through all of this year, it's only seen 5 days of outflows. That is very rare to just see that consistency in terms of the flows. And really, if you look at the top 10 in terms of inflows on the ETFs, 3 of them are dividend ETFs, not something you see too often.
Okay, Katie, thanks so much. Thanks for joining us. Bloomberg's Katie Greifeld with the latest on the ETF market. And tune in to Bloomberg ETF IQ with Katie and Matt Miller every Monday at 1 p.m. New York time. Coming up on the program, 2 separate measures of inflation and 1 conclusion. Higher prices in the United States may be around for a while. We will talk with the chief economist at Goldman Sachs, Jan Hatzius. We'll find out if anything in today's data, what has today's data meant for his expectations around the Fed. We'll get to that conversation. We'll get his take on Europe as well. This is Bloomberg.
about an hour into the U.S. trading session. We got micro versus macro. The U-MISH was actually pretty solid here. Bloomberg's Abigail Doolittle is tracking the moves with stocks right around the highs of the session. Abigail, welcome back, by the way.
Thank you, Alex, very much. I appreciate that. Well, yes, we do have a rally on our hands for stocks. Sharply higher, the S&P 500 up 1.3%. 1.1%. The NASDAQ up 1.4%. Of course, this is a third day in a row higher. This is the best week in 5 weeks. The first time we've seen 2 up weeks since April. And on a monthly basis, we're looking at huge gains. All of this after that FOMC meeting where markets seem to think that there was some sort of a dovish pivot. A lot of commentators thinking less so. And you can see it's confirmed by the VIX with that fear index down at 21.6. Now, I was just mentioning the great weeks. Let's take a look at the monthly performance because it is very, very strong. Investors are serious here. Now, this is back in November of 2020 when we had huge gains in the back of the presidential election and also the beginning of the vaccines. And then you can see we are looking for the S&P 500 at the best month going back to November of 2020. For the NASDAQ, which is up about 11% on the month, the best month going back all the way to April of 2020. That's how strong the buying power is. As for today, let's take a look at what's behind it because as Alex was talking about it, there is, of course, that macro data that looks positive, but we also have the micro of some of these earnings. It's really incredible. Amazon up 12%. This, of course, as they put up a quarter and a guidance that was better than feared. That's the same story for Apple, plus CEO Tim Cook talking about how the supply chains in China seem to be getting, worked out. What's so interesting, though, these quarters, if you go beneath the surface, growth declining, so a little bit mixed, but investors are seeing a better than feared glass half full perspective. This is definitely the case for energy, which you just have this rally that we've had for the last couple of years continuing here as both of these companies put up record profits, confirmed the buyback. In the case of Chevron, actually increased it. Where does this put us for the S&P 500? Well, the bear market rally that we've been talking about for weeks and months, it is definitely underway. However, this is the year-to-date chart, so you can see that there's a pretty strong downtrend. Here's the bottoming pattern that is driving this bear market rally from a technical perspective. It continues to suggest that we could see the S&P 500 go to 4,300, which is basically the top of resistance there. Once at 4,300, it's going to be very interesting. There's so much strength here. You could see a real battle between the bulls and the bears at that point. But the trend overall on the year, Anna, it is down, but no doubt right now we are in a very nice bounce.
Abigail, thanks very much. Yeah, July has been strong. Abigail Doolittle with the latest on the markets. Now, 2 key U.S. inflation gauges posted larger than forecast increases, raising concerns that prices will remain persistently high. Joining us now is Jan Hatzius, Goldman Sachs chief economist, to weigh in on today's data, but also take a much broader view of the U.S. economy and beyond. Jan, really nice to have you with us. So let's start with the narrow data points of today and see if that's changed your thinking at all. The employment cost index, wages a little higher than expected, the Michigan sentiment showing a bit of an uptick in sentiment there, enough to cause a bit of a brief wobble in risk assets as that dovish pivot analysis was sort of questioned for a moment. Did you see anything of interest in the data, anything that challenged your existing views?
No, we didn't really see anything major. It was, as you said, a little bit worse in terms of inflation than expected, but not by a lot. The expectations were already pretty high for both the employment cost index and the core PCE price index. I think it certainly underscores that inflation is way too high, and that's the reason why the Fed is hiking interest rates aggressively with 275 basis point moves at the last 2 meetings and probably more hikes to come. So I don't think it really changes the picture, though.
Jan, when do we get a recession then? Because WIRP on the terminal is looking at cuts now in May of next year. That is not at all what the SEP looks at, the Summary of Economic Projections. It didn't feel like that's what Jay Powell was talking about in his presser as well. When do you think we get the recession and the dovish pivot?
We don't have a recession in our baseline forecast, although that is a pretty close call. We do think that the risk of a recession over the next 12 months is maybe 1 in 3. And I do think that it's a narrow path to a softish landing, but I think we're still on that path. Our forecast is that the labor market continues to soften, but gradually, with most of the adjustment coming through open positions as opposed to a sharp increase in the unemployment rate. but and I think we are seeing some signs that that's the path we're on, but a recession is certainly very possible. In terms of market pricing, I would say that the market has a probability of recession that is probably also in the maybe 1 in 3 range. If I look at the fact that the funds rate under market pricing goes to the low to mid 3s in around the turn of the year, and then about 1/3 of that is unwound in the subsequent year or year and a half. To me, that sounds like the market is certainly putting a reasonable probability on a recession, but not really as the baseline case. Because if it was the baseline case, then I think you would see even deeper cuts priced in.
Do you think the market is expecting the pivot from the Fed too soon, though, Jan?
No, I think that the pricing of the next few meetings seems pretty reasonable. I mean, our forecast has been 50 basis points at the September meeting, and then another 25 basis points at both the November and December meeting. And the market's reasonably close to that. Mm-hmm. Market's priced for, a possibility of another 75, but more likely 50 in September, and then a slowdown, a significant slowdown as you go into the next couple of meetings towards the end of the year. So to me, that seems pretty reasonable. In the baseline, I think if you stay out of recession and you have only very slow growth, well below trend growth in 2023, I don't think you're going to get any cuts. But again, the market is sort of averaging over a range of different scenarios.
Jan, there was a lot of question as to the offhanded comment about Powell talking about neutral on Wednesday, and since then, I feel like everyone's weighed in. What is neutral, and what do you think the Fed actually winds up getting to?
The neutral interest rate?
Yeah.
Look, I think this is something that obviously plays an important role for a lot of economists. My own view is that the neutral interest rate isn't a particularly useful concept. It's very hard to measure. It changes quite a lot over time. I think it's more important for the Fed, rather than hitting any particular level of a quote-unquote neutral interest rate, to focus on financial conditions and make sure that financial conditions are in a place that is consistent with them hitting their target over time. The FOMC has a projection of neutral. It's 2.25% to 2.5%, and so in that sense, the comment from Powell was, we've now hit that that level. But in my own thinking about the economy, it doesn't play a huge role.
Okay, let me take you across the Atlantic to Europe then, Jan, and paint a picture for us of what the winter looks like to you in the Eurozone economy, whether we keep the taps open from Russia at very reduced levels or not. How troubling a time are you expecting to see economically? Because, of course, the data today actually came in much ahead of expectations, but real questions about the winter.
Yes, and we are forecasting a recession in the euro area, on the back of the reduction in gas flows. So even if you keep some gas flows in place at 40% or 20% or 40% of the sort of pre-war flows, I think even then mild recession is likely in the second half of this year and going into next year. I think if you were to see a complete end to Russian gas shipments, which is certainly very possible, then it would be a deeper recession. But I think even without that, a mild recession is likely in the euro area as a whole. I think it would be concentrated in Germany and Italy, which are the two countries that are most dependent on Russian gas.
Jan, do you expect the ECB to be able then in that case to keep raising rates? Because the data on the high inflation today all of a sudden moved sort of to 50 basis points for the ECB in September, but no doubt they're going to be hiking into weakness. What did they do?
I think they will be hiking into weakness, and I would expect them to still go 50 basis points at the next meeting, and I would expect additional hikes, though probably at a slower pace thereafter. We did cut our terminal deposit rate forecast to 1.5% from 1.75 when we moved to an outright recession call for the euro area